Previously, of course, we started with our discussion of variance analysis. We started with our example web organization or web company that have a manufacturing process of a particular product, which is jackets. And of course, we assume some of the assumptions according to inventory, according to the costs that are incurred within this organization. Of course, we saw that we started our analysis with level 0 variance analysis, which only gave us the difference or the variance between the net operating income according to the static budget and the net operating income according to the actual results or the actual income statement. And then from level 0, we moved up with the levels, increased the amount of details that we used in our variance analysis in order to present something called level 1 analysis. And according to this level 1 analysis or variance analysis, we saw that this static budget variance, from where it exactly comes. And we saw, according to the static budget variance, that this variance is because of the differences within revenues, the differences within variable expenses, and the differences within fixed expenses. And then at last, we move to level 2 analysis. Of course, according to level 2 analysis, we we increased the amount of details or the degree of details that was presented in level 1 analysis. According to level 2 analysis now, the static budget variance was classified or was divided onto 2 different variances. The first is called the sales volume variance, which is because of the difference between the actual and budgeted number of units sold, produced and sold. While as the second cause or the second classification or the second division of the variance or the static budget variance is the flexible budget variance. And we said the flexible budget variance is because of the efficiency of the operations of this organization. It means that the flexible budget variance is related to the differences in prices or differences in quantities of, let us say, the different costs, whether it is variable or fixed. Of course, the flexible budget variance can also be classified into a selling price variance, which is, the selling price variance, of course, is the difference between the sales in the flexible budget and the sales in the actual results. This is called the selling price variance. And then we would have the variable expenses variance, which of course the direct materials variance, the direct manufacturing variance, and of course the variable manufacturing overhead variance. And then we would have the fixed manufacturing costs variance. And we said that this fixed manufacturing cost variance is not because of the quantity. Why not? Because, as we said, according to our definition to fixed expenses, these expenses or these costs should not change according to the change in the number of units sold and produced. Therefore, the differences here is related to the price and the price that is paid to these different fixed expenses. And of course, we said that this chapter would only consider or would only emphasize or focus upon the direct materials variances and the direct manufacturing labor variances. And we said that any manager needs more details in order to make any decisions, in order to make any corrective actions, in order to make any corrective steps of any problems that was faced by the organization. Therefore, a manager needs to understand why did we have exactly 21,600 unfavorable variance for the direct materials, and managers also need to understand why did this organization have a 38,000 unfavorable direct manufacturing labor variance. And of course, we said that we can classify these variances or direct variances, whether it is for direct materials or direct labor, onto two classifications. The first is the price, or of course the rate variance, and the second is the efficiency or the usage variance. Now, let us consider the same example of web company in order to see exactly what is the amount of price variance for the direct materials and what is the rate variance for the direct manufacturing labor and what is the efficiency or usage variance for the direct materials and the direct manufacturing labor. Of course, according to our information that is presented for this organization. As we can see here, the example states that the standard direct material cost per jacket is as follows. Of course, in the last lecture, we started or we finished our lecture by a discussion on where we can have or where we can obtain the information for our budgeted prices and budgeted quantities. Because as we said, the price variance or the rate variance is calculated by the comparison between two things. By the comparison between the budgeted price and the actual price. While as the efficiency or usage variance could be calculated according to the comparison between the budgeted quantity and the actual quantity. And we said that the budgeted price and the budgeted quantity could, or this information, or this type of information of budgeted prices and budgeted quantity could be obtained by using different sources of information. Either by using past information, but we said that it had a problem of carrying any inefficiencies from previous, let us say, years, previous fiscal years, onto the coming years, which is a big problem for us, because this means that we are saying to our employees that they need to do exactly what they have been doing. Therefore, if they have been doing or they have been operating the machinery of the, or they have been operating the, let us say, the manufacturing process in an inefficient way, they will they will continue doing the same in the coming years. Therefore, it would be a big problem for our organization, because as we all know, we need to have this continuous improvement. Because if we did not improve, our competitors will improve. If our competitors will improve and we would stay the same or even decrease our efficiency, this means that we are going to lose market share and eventually get out of the market. Therefore, we need to have this continuous improvement. Therefore, we do not need to carry any inefficiencies from previous years onto the coming years or the future years. But at the same time, we have the advantage of obtaining this information at low costs. Why? Because we already have an accounting information system that is recording all the information that we need. Therefore, I only would take the information from this accounting information system and then implement it or use it as a budgeted prices or budgeted amounts for the coming years. Therefore, the use of this information or the obtaining of this information would be at low costs. Another problem in using past information is that it will not consider any changes in the environment in the future, because I'm operating under the assumption that the environment or the environmental factors in the future would be the same as in the past, which is sometimes correct and sometimes not. So using past information would not consider any future changes in the factors of the environment. Number two, or source of information number two that we could obtain or that we could use to obtain the budgeted quantities and budgeted price is by the use of the amounts or the costs or the information from competition or competitors. Of course, this would be a great, let us say, source of information, because we are going to benchmark ourselves with the competition. We are going to relate our efficiencies with the competition. Therefore, we are going to try to compete. We are doing this in order to compete within a specific market. But the problem is that this type of information is kind of hard to obtain, because as we might all know, that competitors would not give this information away to outsiders. This would be the disadvantage of using the competitors' information. Of course, at last, we said that the last source of information in obtaining the budgeted quantities and budgeted prices is using standards, or standard costing, or something we call standard costing. Therefore, the standards are these amounts of costs or prices or quantities that to be used by the manufacturing process that is obtained or that is determined according to engineering studies. Therefore, engineers in our organization would make research in order to relate the physical amount of direct materials that needs to be used in order to produce, for instance, 1 unit of this product. What is the amount of labor that is needed to be used in order to produce one product or 1 unit of a product? What is the amount of machine hours that needs to be used in order to produce one product, and so on? Therefore, according to specific research, according to engineering research, they come up with exactly what is the amount of resources that is needed to be used in order to perform our manufacturing process, or in order to produce 1 unit of our product. Therefore, the standard costing is a good source of information, because of course we are not carrying any inefficiencies. We are determining the exact amount of materials, for instance, the exact amount of labor that needs to be used within the manufacturing process. Therefore, it is a good source of information, but of course, this source of information would be expensive to employ, because as we all know, we need to have research, we need to obtain information, we need teams of engineers and so on. Therefore, it would take time and effort in order to produce the standards. According to our example, Web Company uses this standard costing. That means the engineers came up with engineering research in order to determine exactly what is the quantities and what are the prices of the direct materials to be used, and what are the quantities and prices of direct manufacturing labor to be used, of course, among others. As we can see here, that the standard direct material cost per jacket is as follows: 2 square yards of cloth input allowed per output unit, which is the jacket, of course, manufactured at $30 standard price per square yard. This means, according to our research, we found out that each jacket should use up only 2 square yards of cloth, which is the direct materials for producing the jacket. And also, according to our research, of course, marketing research, not only engineering research, according to our marketing research, we found out that the price of square yard would be $30. These are the standard quantities and standard prices. Therefore, as we can recall, what was the direct materials cost per jacket? It was $60. Therefore, how did they come up with this $60? They said that each jacket needs 2 square yards, each square yard needs $30 or has a price of $30. Therefore, the cost per jacket would be $60, which is the same amount that was presented in the beginning of this example. Correct? Any questions? Now, according to the standard direct manufacturing labor cost, according to our research also, we found out that each jacket needs 0.8 manufacturing labor hours. In order to produce one jacket, we need 0.8 hours by our manufacturing labor in order to produce this jacket. Of course, the hour or the standard price or the standard rate of 1 hour of manufacturing labor would be $20. Therefore, $20 and 0.8 hours that is needed would cost us $16 per jacket, which is the same price or the same cost, sorry, as we introduced at the beginning of this example. Therefore, how do we come up with these quantities or with these numbers or with these costs? By the multiplication of the price multiplied by quantity. By this, we can compute or determine the amount of costs of each unit of this jacket, of course, for the different items or different classifications of costs. Now, they gave us, or they presented us with the actual direct costs and the actual direct manufacturing labor. Therefore, by this information, we would have the budgeted price and the actual price. By this information presented in the example, we would have the budgeted quantity and the actual quantity. If we have these different classifications of information, therefore we are able to calculate or determine the price or rate variance and the efficiency or usage variance. Correct? Therefore, according to our example, the square yards of cloth input purchased and used, because as we said, according to our assumption at the beginning that there is no beginning or ending direct materials, or let us say the raw materials inventory. Therefore, what we purchase, we use in the manufacturing process. Therefore, we use 22,200 according to 10,000 jackets. Remember that we are now talking about 10,000 jackets, not 12,000. Therefore, we use 22,200 square yards according to an actual price of $28. As we can see here, we have differences in price and we have differences in quantities. Because according to the quantity, we should have 20,000 square yards, and according to our standard, we should have $30 here, not 28. But as we can see, we have differences between the budgeted and actual quantity and the budgeted and actual prices. Therefore, as we can see here, the 621,600 that was presented in the actual income statement was calculated according to these actual quantities and actual prices. The 22,200 multiplied by 28. According to the example also, the direct manufacturing labor hours that has been used up within this manufacturing process is 9,000 labor hours, while as the actual price incurred per direct manufacturing labor hour is $22. Therefore, $22 multiplied by 9,000, $198,000, which is the same amount that was presented in the actual income statement. Now, after we are presented with this information, we need to perform our last level of analysis, which is level 3 analysis. Level 3 analysis, as we will see, would divide our flexible budget variance for direct materials and direct manufacturing labor onto two classifications. The first is a price variance or a rate variance, and the second would be an efficiency or usage variance. So as we can see here, the best way in order to present our analysis is to present it according to this tabular analysis. Of course, we could calculate the differences without the use of this tabular analysis, but this would be much easier to use in our presentation or in our analysis. Therefore, in order to present level 3 analysis, we need to have 3 columns. The first column is the actual costs incurred, which is the actual quantity or the actual input quantity multiplied by the actual price. The third column would be for the flexible budget. The flexible budget is according to what? Is according to the budgeted input quantity allowed for the actual output. What do you mean by this? Budgeted input quantity allowed for actual output. That means we are going to calculate the budgeted quantity for the 10,000 units actual output level. Multiplied, of course, by the budgeted price. And of course, in between, the second column would be the actual input quantity, but multiplied by the budgeted price. So as we can see here, if we are going to compare column 3 with column 2, the only difference is according to the quantity. Here is the budgeted quantity, and here is the actual quantity. Of course, here is the budgeted price, and also here is the budgeted price. Therefore, any differences between column 3 and 2 is because of the price, is because of the quantity, is because of the difference between the budgeted quantity and the actual quantity. Therefore, the difference between column 3 and column 2 is the efficiency variance. And then, if we compare column 2 with column 1, as we can see here, actual input quantity and actual input quantity, there will be no difference in quantities. But the difference would be according to the price. Here we use the budgeted price, but here we use the actual price. Therefore, if we have any differences between column 2 and column 1, would be attributed to the change in price, would be attributed to the difference between the actual price and the budgeted price. Therefore, the difference here is the price variance. Any questions? Now let us see how we are going to calculate the variances. Of course, the actual input quantity. What is the actual input quantity? According to our example, according to the information that was presented, we used 22,200 square yards. Correct? This would be the actual input quantity. Of course, multiplied by the actual price. The actual price was, according to our example also, it was presented by the amount of $28 per square yard. Now let us go to the second column. The second column is the actual input quantity. Again, the actual input quantity, according to our example, was 22,200 square yards. Multiplied by the budgeted price. The budgeted price is according to the standard. According to the standards that were reached or obtained by the research that has been done within the organization, which was $30. Therefore, the difference here between the 621,600 and the $666,000 is the price variance. The price variance of 44,400 favorable variance. Why is it favorable? Because as we can see here, we should have incurred 60 or 666,000, but we have incurred only 621. Therefore, as we can see, the costs decreased from the budgeted or in relation to the budget. Therefore, this is a favorable price variance. Any questions? Now, let us compare column 3 with column 2. Of course, the budgeted input quantity would be according to the 10,000 units, as we said, because this is a budgeted input quantity allowed for the actual output. Because as we all know, as we all said, the flexible budget is prepared according to the actual output level, the 10,000 units. Therefore, according to our standard, we said that each unit should use up 2 square yards of cloth. This means that 10,000 units would use up 20,000 square yards. Therefore, the budgeted input quantity for the 10,000 would be 20,000, which is the 10,000 multiplied by the 2 square yards. These two is considered the budgeted quantity. Of course, multiplied by the budgeted price also, which is the $30 according to our standard. Therefore, if we compare the $600,000 that is presented within our flexible budget and the 666,000, the only difference or the only cause of this difference between these two amounts is because of the difference between the budgeted and actual quantity. Therefore, the 66,000 unfavorable efficiency variance is because the difference between the budgeted quantity and the actual quantity is the difference between the 20,000 square yards and the 22,200 square yards. Of course, as we can see here, we have an unfavorable variance because we should have incurred only 600,000, but actually, according to our actual input quantity, according to the actual number of square yards that has been used in the manufacturing process, we incurred $666,000. Therefore, the costs increased according or in relation to our budget. Therefore, it is an unfavorable efficiency variance. And of course, the same goes through to the direct manufacturing labor. As we can see here, 9,000 hours according to our example. This was presented according to our example, multiplied by $22 per hour. Therefore, the actual is 198,000. The actual also input quantity is 9,000 hours, but multiplied by the budgeted price, not the actual price. Therefore, the difference between column 2 and column 1 is only because of the change in the price between the budgeted and the actual. Therefore, as we can see here, we should have incurred only 180,000, but actually we incurred more. We incurred $198,000. Therefore, as we can see here, we have an $18,000 unfavorable price variance. Now, the flexible budget, according to our standard, according to the research that has been done within the organization, we said that each unit should use up 0.8 hours. And according to our actual number of units that has been produced, we produced 10,000 units. Therefore, we should have used up to 8,000 hours according to our budget. But actually, we used 9,000 hours. Therefore, the difference between the 8,000 and the 9,000, as we can see, the $20 did not change from column 2 to column 3. Therefore, the change or the difference here between column 3 and column 2 is only attributable to the change between the budgeted and actual quantity, the change between or the difference between the 8,000 budgeted and the 9,000 hours that is actual. Therefore, as we can see here, we should have only incurred 160,000, but actually we incurred 180,000 because of the increase in the number of labor hours that has been used. Therefore, as we can see, we have a $20,000 unfavorable efficiency variance. As we can see here, 66,000 unfavorable efficiency variance plus, because this is unfavorable and this is the favorable. Therefore, 66,000 unfavorable efficiency variance plus the 44,400 favorable price variance would give us the 21,600 unfavorable flexible budget variance. This variance was presented in our level 2 analysis. Therefore, as we can see here, by implementing the level 3 analysis, we detailed the 21,600 unfavorable flexible budget variance to an efficiency variance and to a price variance. And then, according to our direct manufacturing labor level 3 analysis, we have a flexible budget variance by the amount of 38,000 unfavorable variance, which was presented in our level 2 analysis. According to our level 3 analysis, we were able to divide this variance onto two different classifications. The first is the efficiency variance by the amount of 20,000 unfavorable, and a price variance by the amount of 18,000. Because the two are unfavorable, therefore the 38,000 is calculated by adding up the 20,000 and the 18,000. As we can see here, if one favorable and one unfavorable, it would be deducted. But if the two are unfavorable or the two are favorable, the both would be added. Any questions? By this, we would finish our variance analysis for only the direct materials and direct manufacturing labor. We started with level 0, and then level 1, and then level 2, and then level 3. And as we can see, each level was more detailed or classified the variances onto more details than the other or than the previous level that was presented. The last point in the variance analysis, or how to calculate the variance analysis, of course, we finished from the part of the flexible budget. We started with the level 0 and finished with level 3. But according to our level 2 analysis, as we showed in our level 2 analysis, we said that we would have also a sales volume variance. And we said the sales volume variance could be attributed or attributable to two things. Either the change within the expected market size and the actual market size, or the second cause would be the difference between the actual and expected market share. Therefore, also, we could analyze the sales volume variance onto two different variances. We can classify the sales volume variance onto a market size variance and a market share variance. Let us take an example or extend our example in order to see how we are going to analyze this part. Of course, this is presented in your appendix. Appendix number 1 in your book at the end of the chapter. Therefore, according to the example, or according to the extended example of web company, they said, or they presented, that management estimated a 20% market share and a market size of 60,000 units. Therefore, in preparing the budget, management estimated that we would have 60,000 units as the market size, the overall market size. That means that the market would sell 60,000 jackets. This was the estimation by the management. And it also estimated that our share of this 60,000 units is 20%. This means that we would sell 12,000 jackets in this market. According to, as we can see here, the 12,000 was estimated according to two things. According to the market size and according to the market share, or the share of this organization from the market size. Any questions? Of course, this is an estimation. Now, what has happened actually? Let us see. Actual market size was 62,500 units. Therefore, we have an increase in the market size. But the actual market share was only 16%. How did we calculate this 16%? We calculated the 16% according to the 10,000 actual units that were sold. We said, according to the example, that we sold an actual amount of 10,000 units. We sold the 10,000 units from a market size, or actual market size, of 62,500. Therefore, what is the percentage of this 10,000 from the 62,500? It is the 16%. Therefore, the 16% would be calculated according to the actual number of units sold and the actual market size. Now, according to this information, as we can see here, we can divide our sales volume variance onto two different classifications: the market share variance and the market size variance. As we can see here, the actual market size multiplied by the actual market share would give us the amount of $320,000. Of course, the 62,500, which is the market size, the actual market size, multiplied by the 16%, which is the actual market share, of course, multiplied by the 32. What is the 32 exactly? It is the contribution margin, which was introduced in cost accounting 1. What is the, or how we can calculate the contribution margin? The contribution margin is the selling price, or the sales minus the variable expenses. Of course, we had the sales by the amount of $120, I think, and $88 the variable expenses. Therefore, $32 would be the contribution margin. Correct? Of course, as we can see here, the $32 and the $32 in the second column and the third column did not change at all, because we are not considering any changes between the actual and budgeted contribution margin, because this would be analyzed in the flexible budget variance according to the direct materials variances, direct manufacturing labor variances, according to the variable manufacturing overhead variances and the fixed manufacturing overhead variances. We here are only focusing upon two things: the market size and the market share. Therefore, in the second column, we would multiply the actual market size by the budgeted market share. Therefore, the actual market size was 62,500, but the budgeted market share, or the expected market share, was 20%. Therefore, the difference between column 1 and column 2 is only attributable to the change in the budgeted market share and the actual market share. Therefore, we should have $400,000 according to our market share. This was the contribution, or this is the budgeted contribution margin that should have been presented, or should have been achieved according to our budgeted market share. But according to our actual market share, we only achieved $320,000. as we can see here, the actual contribution margin was less than the budgeted contribution margin. Therefore, we would have an unfavorable market share variance. On the other hand, if we are going to compare the market sizes, we are going to keep the market share constant. Therefore, according to our static budget, the budgeted market size by the amount of 60,000 and the budgeted market share by the amount of 20%, of course multiplied by the budgeted contribution margin, would be compared to the actual market size multiplied by the budgeted market share. Therefore, the only difference between column 3 and column 2 is attributable to the difference between the budgeted market size and the actual market size. According to our estimation, we should have a contribution margin by the amount of 384,000, but according to our actual market size, we had a 400,000, which is an increase. Therefore, we had an increase in the contribution margin. Therefore, we have a $16,000 favorable market size variance. Of course, this variance is mostly out of the control of any organization. If we are saying about the market size cannot be influenced by one organization. It is influenced by the whole organizations operating within a sector, and of course many economical factors within a country. Therefore, the market size variance, whether it is favorable or unfavorable, it is hard to, let us say, analyze and see exactly what went wrong. Maybe what went wrong is our estimation. Maybe our estimation was off. Maybe we had problems in estimating the market size. But we also need to consider that there are a lot of factors, many factors that would affect the market size. Therefore, a lot of managers would not emphasize or focus upon this variance, because this variance, as we said, is out of the control of the management. While as the market share is a very important variance that needs to be considered by any management, because the market share is according to what we are doing within our organization. Maybe we had, as we said earlier in the previous lecture, maybe we had problems in the quality. Maybe we had problems in our customer service. Maybe we had problems in efficiencies, for instance. Maybe we had problems in understanding the customers. Maybe we had problems in our price. Maybe our price was more than the prices within the market, and so on. Therefore, these factors would affect the market share within the market. Therefore, this would be emphasized, this would be focused upon, while as this variance would be known, of course, and would be analyzed, but it would not be detailed, it would not be let us say emphasized or focused upon like the market share variance. Any questions? By this, we would finish our lecture for today. In the next lecture, inshallah, we are going to see how we are going to journalize our variances, how we are going to use our accounting information system in order to consider the different variances and present our different variances within our accounting information system. Thank you for listening, and I'll see you inshallah the next time.